Thanks very much, Esther. And thanks everyone for joining us today for what is our 31st edition of our annual survey. As Esther mentioned, we have had another challenging year producing this edition. Companies House have given another filing deadline extension to those companies that have requested it. And what that means is today we're launching our preliminary results. So these results are based on the results of the 140 or so companies that have already filed. And then once everybody else catches up and they file their results, we will release a full report, hopefully early next year. So as Ian did last year, this session is going to cover off the average results across all of the disciplines for 2020, along with some results from our latest online survey, so that we can really get a feel for how agencies are performing this year and also what expectations are looking forward to 2022. Before we start, just a couple of quick reminders. So all of the data that we use for our survey are taken from accounts filed with Companies House. Most of these accounts are audited, but even if they're not, all of the information we publish is publicly available information. Sometimes we do make adjustments to this filed data, but we try not to. We only make those adjustments if it means that the data is more comparable. So the most common adjustment that we would make is to ensure that staff costs is treated the same from agency to any agency, again, so that we can then compare like with like. So let's get started by having a look at revenue growth. Now, throughout this survey, when I'm talking about revenue, I mean gross profit, fee income, or gross income. Now, for the majority of agencies, the 2020 figures that are appearing on our chart now are for either their year ended December 20, and for a few agencies it could be their year ends March 21. So it's no surprise really that a large proportion of those agencies saw their revenues decrease, as this was our year when the pandemic hit, and as you can see there, across the board decreases in revenue. I think kind of going back to the start of the pandemic, most agencies initially saw kind of complete freeze on spending. Their clients were kind of pausing or cutting budgets, trying to work out how they were going to be impacted and how they were going to kind of make sense of everything moving forward. Once things had started to settle down, to some extent it was luck as to how individual agencies fared. So for example, those agencies with clients in the retail and live events sectors tended to be kind of worse affected, whereas those who had clients in, say, the technology and healthcare sectors, actually they saw their revenues come back more quickly, and actually some saw real opportunities and growth there as well. So just having a look at some of the results for the individual disciplines in a bit more detail. We've got direct marketing and sales promotion agencies being the worst impacted. They saw their revenues fall by nearly 15%. However, to be honest, over the past few years, that sector's really struggled, and we've barely seen kind of growth rates above a couple of percent. So it's not completely a surprise there. Media buyers, they also saw a significant decline, over 14%. We would probably expect that given just the decrease in demand last year for media. It was actually digital, the other significant decrease, which I think is more surprising. Their revenue fell by nearly 14%. Now, digital does tend to be a very project-focused sector, and so it could be that those projects just fell away very quickly, but actually kind of digging down, lots of agencies did say that the type of work that they were doing for their clients changed, and that had an impact on their revenues. So we'll come on to how that's actually impacted their profit margins later. The other kind of subsector, PR, so they were the least impacted. And that is largely due to the fact that for PR agencies, they tend to have the largest proportion of retained fees. So once things had settled down, those revenues came back. So those are all of the averages for our individual disciplines. Next, we're going to have a look at our historic averages going back 30 years, looking at how this year's revenue decrease has compared. So we can see here the past 30 years individual results, and then we've got across the top an average for each of those 10-year periods. So we can see that the average growth rate has declined, but if we pick out some specific years for reference, so 2020, unfortunately, this is our 10% decrease in revenue. And going back to the other kind of low points we had, 2009, so that was the impact of the recession. And there back in 2002 to 2004, that was the impact of the dot-com crash. And actually, that was the only other year in 2003 where we saw revenue decrease. So when we look at the results for 2020, we really can see how significantly the sector was impacted. I'm sure you don't need me to tell you that. But what I think is interesting, and we'll come on to, is how quickly revenues recovered after these previous shocks or lows. So with that in mind, what do we think 2021 and 2022 will look like for the sector? Well, let's start by just analysing the results for 2020 first. So here on this slide, we've got a bar for every individual agency that we've included results for within the survey. And they are colour-coded according to their discipline, and each is plotting their revenue growth for the year. Then what we've done is we've ordered them. So on the left-hand side, we've got those that reported decreases in their revenue through to those that were lucky enough to report increases on the right-hand side. There were actually only 14 agencies that saw an increase from 2019. And just to kind of put that into context, when we look back to the results that were recorded for 2019, that in itself was also a challenging year. It was the year where the sector felt the impact of Brexit and the uncertainty around that. So unfortunately, a couple of difficult years for the sector. So next, what we've done is we have plotted these bars into groups, giving us something that we can compare our online results to. So as we can see there, the average decrease in revenue for 2020 was 10%. Now let's have a look what the responses from our online survey gave for expectations for 2021. So encouragingly, revenue growth of 13.63%. Obviously, when we look back at those averages, that is encouraging. But I suppose off the back of such a difficult year, what does this really mean? We also asked agencies to compare how they were expecting 2022 results to be compared with 2019. So our last kind of normal year, if you call it that. And encouragingly, the expectation is that growth on 2019 revenues for 2022 will be 16%. So maybe these are optimistic, but actually what you've got to consider is for this 2022 average, this is over a 3-year period. So it probably works out roughly in line with the average of margins over the past 10 years if we exclude the anomaly of 2020. So positive signs looking forward. But let's have a look at the story behind the results of 2020 in terms of the profits. So our next graph is plotting our revenue growth for every agency in our survey against the individual agencies' operating profit margins. And we've got, again, the different colours for all of the disciplines, and then a trend line there. Now, in most years, we talk about how key revenue growth is to achieving a reasonable operating profit margin, and that is still the case, but this year things were slightly different. So with such a decrease in revenues across the board, we would expect to see far more companies in the bottom left quarter on this graph. So we'd expect them to be reporting operating losses rather than profits with such a hit to their revenues. But actually instead, as you can see, there's far more agencies in the top left quarter. So despite these falls in revenue, they still managed to report profits. So let's have a look at this in more detail. Again, we've got the average operating profit margins here for each of the disciplines from last year's survey. And then we have the 2020 operating profit margins for those companies that have filed this year. Now, there are some interesting movements which we'll come on to, but largely, as we might expect, the sectors have reported reduced margins for 2020. But I think it's just really important to remember that this is off the back of a historic decline in revenues. So actually, these results are really not as bad as you might think. And with everything considered, they could have been a lot worse. If we just have a look at some of the specific subsectors, taking top 50 to start with. So the headline figures there do actually show that 2020 operating profit margins were an improvement on the 2019 results, which doesn't look quite right. But remember, not everybody has filed their accounts yet for 2020. So we've technically got an incomplete population. So to make things more comparable, we've also looked at the results of the same companies for 2020. And then again, if you look at the top 50, it shows that margins decreased from 10.7 to 10.1, which is in line with what we'd expect. Across the other subsectors, DMSP and PR, they both saw slight increases. Their margin held there or thereabouts. Again, it was digital's results that stood out as being unusual. And as we said, this was on the back of actually quite a significant decrease in revenues. So digging down and understanding what went on here, I think agencies were able to stop their use of freelancers quickly. Digital is the sector which tends to have the highest reliance on freelancers in normal times. So they were able to stop using those very quickly to protect their margin, but also the work that they were doing and the drive for digital during the pandemic has undoubtedly impacted them and actually led to them being able to kind of charge more, a premium for those services that they are delivering. So focusing more on the digital transformation and strategic offerings. We're just going to finish our kind of review on the headline margins by looking at the profits of the individual disciplines over the past 30 years in this graph. It shows us how the individual disciplines kind of compare to one another and how we've actually seen the trend of those margins kind of aligning over the period, but also just in terms of the average margin across the board and the trend of that decreasing. So what can we expect then from 2021 and 2022? Let's have a look. In the same way that we looked at revenue, we have also plotted this graph for operating profit margins to help us compare the results from our annual survey to our online survey. So again, we have a bar for each company that filed as part of our annual survey analysis. And as I'm clicking through, you can see that's all of the different subsectors. And then we've ordered that data. So we've got those agencies that made an operating loss on the left, and those agencies that made an operating profit on the right. Now, this, when we then put the data into our buckets to compare it to the online survey, gives us an average operating profit margin for 2020 of just over 10%. Now, this isn't a particularly high margin, but like we said, on the back of the decline in revenues, it's actually quite positive. So 2021, we had responses from agencies saying that they were expecting a margin of around 13%. And then for 2022, they were even more optimistic with an average of 15.2%. Now, it could be that there is some optimism in these results, and it's by no means a completely full population, but I think it gives us a really good sense of how agencies are feeling. And also it's a testament to how well placed the sector is to move forward after last year. I did actually go back and have a look at some of the responses we'd received last year when we'd asked agencies what they expected 2020 to look like. And the predictions were in the same ballpark. I think they predicted a margin of around 8%, and obviously we ended up slightly higher than that at 10%. So not a million miles off. Next, we're going to have a look at how staff costs and spend on staff costs relates to our operating profit margins. This first slide that we've got plots our operating profit margins against staff costs as a percentage of gross income for every agency within our survey. And if you've been to one of our events before, or you're one of our clients, you'll know that we set a benchmark target for agencies to try and keep their staff costs within 55 to 60% of gross profit in order to have a good chance of reporting a reasonable margin. Now, you can see that very clearly in this graph. If we look on the top right-hand side, there are very few agencies in this space. So very few agencies are able to report a decent operating profit margin if their staff cost spend is over this. So this graph is largely as we'd expect. It is slightly steeper, and that is because of a few things that we're going to come on to. So firstly, how has furlough impacted spend on staff costs and therefore operating profit margins for agencies in 2020? Now, for statutory purposes, the furlough income or furlough grants received weren't netted down with employment costs in agencies' accounts. Actually, they were separated out and shown in other income. Now, some agencies kind of gave the narrative on this, and others kind of lumped them in with other income that we had. So we couldn't take the data from all of the companies as part of the survey, but we did do our own research amongst our client base, and for those clients where we could look at the data to get an idea of what difference this would make to the results. So going back to our average spend on staff costs for each agency in 2020. That was 62.9%, up from 60.2% last year. But like we said, the difference being that this year, those agencies on average received 1.8% revenue in furlough grants. So what that does is that reduces the overall staff cost ratio down to 61.1%. When we look at the results for the survey, actually total employment costs decreased by around 3%. And we know that agencies were actually very proactive, especially at the start of the pandemic, reviewing their staff costs, so making redundancies where they needed to, putting in place pay cuts and restructuring plans. So this has definitely helped protect their position. And I think compared with other events, maybe on a kind of individual agency basis, so an agency kind of losing a key client or revenues not increasing in line with expectations, actually, because it was something that was affecting the whole industry, agencies were much quicker to respond, and that has definitely helped them preserve margin. As Esther touched on, interestingly, 94% of agencies that we did our online survey with expect to give pay rises in the next 6 months, and 72% expect to recruit. So there's definitely kind of the return of talent pressures, and it's really important that agencies keep this ratio in check to ensure that actually margins can recover. So whilst the furlough does go some way to explaining why margins held up despite such a decline in revenues, let us have a look at what impact freelancers and other costs have had. So usually when we're reporting on the data for freelancers, it's kind of another record-breaking year of increased spend on them. Unsurprisingly, that wasn't this case this year, but they did decrease by quite a considerable amount. So on average, and again, this is taken from our own data rather than the survey data because it's not publicly available information, but on average, agencies spent 3.7% of their revenue on freelancers. Now, this compares to more than 8% that was spent last year. So whilst freelancer resource does tend to be more expensive, it does offer the most flexibility. And I think for a lot of agencies during the pandemic, they put a complete ban on using freelancers, or at least increase the kind of controls over the ability to engage freelancers to try and help protect spend. So when we take the freelancers into account, along with the staff costs that we just looked at, adjusted for the furlough rebate, we end up with total employee costs of just over 64%, nearly 65%. Now, this is much higher than the benchmark target that we discussed of up to 60% for total people costs. And if we look back over the past few years, it is the main reason that as a sector, margins have been depressed, as the constant talent shortage and issues with the cost of talent have really kind of put pressure on margins. But at the same time, this ratio is less than we've seen previously, and so it's helped keep margins where they are. So we've had the kind of total spend on people costs, but we've also seen other incentives within agencies, such as rent rebates, less international travel and entertaining. All of those things have had an impact. I think a number of agencies were pretty fortunate that their rent or leases came up for review during the period, and they were maybe able to kind of hold off on committing to new spaces, again, making further savings. We can see in this survey that cost savings were kind of across the board. I think what will be really interesting is to see actually whether these things have to some extent changed for good. So, you know, will we see international travel go back to the levels it was before? Is it really as necessary as we all thought it was? Will hybrid working ultimately reduce premises costs? And could there end up being less pressure on talent given the success of remote working? And not at the moment. I think obviously Esther mentioned there's definitely a lot of demand for talent, and that's a challenge going forward. But all of these things, it will be really interesting to see how they impact results going forward. We often get asked whether directors' remuneration makes an impact to the results that we publish, and whether the fact that there are some agencies within the survey that are independent, and so the owner managers can choose how they take their remuneration, either as, say, dividend or salary, versus other agencies where they have put through salary for directors. Now, the short answer is no, it doesn't. We do carry out an exercise where we have a look at what would happen to margins if we substituted in a fair market rate for everyone. And because of the size of the population and the averages that we're looking at, actually the kind of overs and unders net down to have a really limited impact on those figures. It probably is worth making the point, though, that if as an agency you're comparing your results to our benchmark targets, you should be making sure that you're including a fair market rate for your director's remuneration and your salary costs. Otherwise, those KPIs aren't going to be comparable. So of all the agencies that have filed their results so far, these 10 on the screen now are those that recorded the highest operating profit margins. I think a couple of them at least are watching, so congratulations to them. And I think a special congratulations really, given that these results were achieved during a global pandemic. We can see there an exceptional gross income per head of over 270,000. That was somewhat helped by Lucin Holdings results. Profit margins of over 40%, and staff costs at 43%, so held within our target. A great set of results across the board and individually for all of these agencies. So we've had a look at how the top performers here have fared financially, but as you're rebuilding your agency, what else should you be thinking about in terms of driving value? What else are these agencies doing in order to be able to achieve these results? Well, along with producing this annual survey that we're discussing, we also work with agencies to support them on their growth journeys. And usually we start this assessment by working through 10 key drivers of value, which I'm just going to touch on now. So starting with clients, those top performing agencies have a high quality mix of loyal clients, and there are multiple touch points at those clients or brands. It's also really important that an agency isn't over reliant on any couple of individual clients, and so we suggest that actually no single client should account for more than 20% of your profit. Next, income. So having, as far as possible, a high proportion of current and forecast revenues which come from recurring, retained, or high probability income streams. Now, this can be more challenging if your agency work is project-based, but having repeat work with the same companies or clients, that can go some way to helping drive value through this area. The most valuable agencies stand out. They are different and they excel at what it is that they are doing. They have a clear, compelling and unique value proposition, and that is known to and valued by their target clients. The top performers also have effective, scalable and consistently applied BD processes, and having real structure to these processes as you're growing your agency is really important, because it ensures that new business efforts are targeted, effective and efficient. The most valuable agencies and those that are growing potentially for an exit as well, it's so important that they are not reliant on any of the owner managers. So they shouldn't be kind of critical to the day-to-day running of the business. And instead, there should be a highly capable, engaged, incentivized and committed management team, ideally who are kind of incentivized or locked in, as it were, for the next 3 to 5 years. So we've talked about and we've been through some of the key KPIs for the sector. One of the value drivers here is management information. So making sure that as an agency, you've got high quality data that allows the management team to proactively make decisions based on that data, and that it's, you know, timely information so that those decisions can be made at the right time. Having clear objectives that are underpinned by a compelling business strategy that is implementable. And these valuable agencies have got strong environmental, social and governance proposition, and that is communicated both externally to their clients and prospects and also internally with their staff. And then finally, just finishing here with profit. So we've looked at what the top performers achieved in terms of profit, but it's having consistent historical profit performance and also kind of realistic and robust profit projections. So those are our 10 key drivers of value. And if there's any of those that you'd like to discuss so that we can work with you to help your agency on its growth journey, then please do get in touch. A few final thoughts then before we finish with our Hall of Fame. So there's no doubt that 2020 was an exceptionally tough year for most agencies, with the most significant revenue decrease we've ever reported in the history of our annual survey. Despite this though, agencies were quick to take action to make savings, including using the furlough scheme. And so this meant that overall the impact on margins was minimised. What this has meant is that actually the sector is in a really good place to take advantage of growth opportunities going forward, focusing on rebuilding better. Interestingly, 82% of agencies that we surveyed felt that ESG will be critical or very important to growing their agencies over the next 5 years. And this is something that the panel will be discussing shortly. But before this, who are our winners? Who made it into the Hall of Fame this year? Well, just a quick recap. To gain a place in our Hall of Fame, an agency's got to meet all of these criteria, which is, you know, particularly challenging given everything that we've gone through in terms of what agencies faced in 2020. So firstly, having revenue growth, that whittled us down to only 14 potential contenders. then having fee income in excess of 120,000 per head, having staff costs of less than 55% of revenue, achieving an operating profit margin of more than 20%, having at least 3 months worth of overheads within net current assets on their balance sheet, and then obviously they need to have filed their accounts in order for us to review their results. So just quickly looking at who were the winners last year, and then our winners for 2020. So congratulations to all of those agencies, particularly impressive, like we said, given what a challenging year it's been. So that takes us to the end of our annual survey review. I hope you've enjoyed it, and I will hand back to Esther now for the panel discussion.
Thank you very much, Francesca. A very thorough review of the numbers. I did ask if anyone had any questions. We haven't had too many. I've answered a couple as we've gone along that have been very specific, but there are a couple of questions outstanding. So one of them was, you referred, Francesca, to the survey that we sent out for people to complete, which included the things like, you know, what people thought margins and growth was going to be for 2022. Somebody just asked how many agencies indeed completed that survey?
There were just over 100, so a slightly smaller population, but still a good number. And like I said, for a couple of the predictions that were made in our last online survey, I kind of went back and had a look, and it was a similar level last year. So I think it gives us a good idea.
Yeah, definitely a meaningful number. And the other question is, how much are profit margins being impacted or indeed looking better through the shortage of staff?
I suppose it depends on exactly what they mean by shortage of staff.
Yeah. I mean, I'm thinking that perhaps the impact of that's going to be seen a little bit more in 2021 and the numbers that we have yet to see, rather than the 2020 numbers, because I think for me it's been more this year that clients have been talking about that rather than last year.
Yeah, absolutely. I suppose also what will be interesting is where maybe the talent shortages meant that agencies are using more freelancers. Actually, we've got the new rules on freelancers that have come in April 21, whereby actually an agency has to consider whether or not those individuals go on their payroll rather than them being, you know, paid as a limited company. So it'll be interesting to see how that affects our averages next year.
Yeah, I mean, and also, you know, given that there is a shortage of staff, you know, inevitably that leads to wage inflation that I sort of alluded to in my introduction. So to a degree, any benefit from sort of not being able to recruit, well, benefit is just sort of not really a benefit actually, because some clients have to actually turn work away because they haven't got enough staff. But any benefit there is probably going to be cancelled out a bit by wage inflation, I would have thought. But I mean, generally speaking, I mean, given that the sort of the high level of growth is predicted for next year, generally speaking, when there is a high level of growth in fee income, we do tend to see margins nudge upwards, because it tends to be that you recruit slightly behind the speed at which that new income is won. Oh, got another couple of questions have appeared. How is fee income per head calculated? Is it all staff or just billable staff?
So that is all staff. So we take your kind of revenue and then divide it by total staff numbers. So those that aren't revenue generating as well. Okay.
And another question, with relatively low profit margins, why do you think VCs or private equity houses are so interested in the sector? Well, I suppose part of that is the opportunity. I mean, maybe they think they're going to get them at a cheap price and there's lots of growth built in there. I suppose it's fair to say that they're not necessarily just interested across the whole marketing services spectrum. It tends to be where there's a sort of a data analytics, digital research focus. So it tends not to be the pure creative agencies. So those where private equity houses consider there is sort of scalability there. So there is maybe some IP there. There is value beyond just what they can create with people on the ground. So perhaps less impacted by the shortage of talent. Oh, lots more questions coming in. What is, I don't know whether we asked this in the survey that we sent out, did we, Francesca? What's the average wage increase in 2022 expected to be? We asked whether people were going to give a pay rise, but I don't know if we asked how much, did we?
No, we didn't.
No.
Yeah.
We didn't. Apologies for that. We'll add that to the next survey. But I mean, for some agencies, I suppose that there might be a little bit of element of making up for the pay rises that they didn't give during 2020. But broadly speaking, a lot of clients I'm talking to are thinking of giving sort of, inflationary pay rises. The key thing there is to make sure, of course, that you pass that pay rise on to your clients through your charge out rates. If a company's year end is March, what accounts do you use for the survey?
So for these 2020 results, we would include the year ended March 21.
Yeah. In the Hall of Fame chart, fee income presumably means gross revenue. Yeah, I mean, it's got lots of names, hasn't it, Francesca? People call it all sorts of things, but
yeah, the same thing.
Yeah, I mean, importantly, it's not turnover. It's turnover less third-party cost of sales, and people might call that fee income, gross profit, revenues. A lot of clients probably call it revenue, I would have thought. Gross profit per full-time equivalent target used to be 100. Your Hall of Fame is 120. Would you recommend as a guide for gross profit per full-time equivalent, considering the pay rise pressure? Well, yeah, I mean, we've probably had it at 120 for a little while now as well. At some point, that probably does need to go up as a target. We thought this year probably wasn't an appropriate year to increase it, but we probably will over the next couple of years. Do we know the balance of agency failures versus startups since March 2020? Well, I'd love to know the answer to that question. Unfortunately, I don't, and I don't suppose Francesca does either, but suffice to say, actually, I think I can hand on heart say I haven't had any clients go bust since the start of the pandemic that's been due to the pandemic. There were the odd one or two that were wobbling anyway, but that was nothing to do with the pandemic. But I think the failures actually have been fairly minimal. I don't know about your client base, Francesca.
I was going to say, I can say, yeah, exactly the same in my client base as well. And there's those that have been, pretty badly impacted due to their kind of specialisms, but no, none of those have gone down.
But that said, periods of turbulence and change conversely do tend to lead to quite a lot of startups. So we are seeing a lot of startups in the industry. So hopefully that ratio of startups would be a lot higher than the business failures. Hurrah, that sounds great. Good. What percentage of gross profit, I don't think we look at this specifically because this information isn't publicly available. What percentage of gross profit should agencies limit their spend on their own sales and marketing to? We have in the past done an internal survey on this, looking at the sort of the detailed P&L amongst our clients. I don't think we've done it recently though, have we, Francesca?
No, we focused on the kind of furlough and the freelancer aspects of that, but it is something that we could have a look at. Yeah,
from my dragging up my memory, I've got quite a small percentage in my head from what it used to be. It used to be around sort of 2, 3, 4%, I think, when we've looked at it in the past, but it might be one that's worth revisiting again. With inflationary rises of around 4%, NI rises of 1.25% from April and a more competitive talent market, is there a feeling that a 50 to 60% wage margin is going to be maintainable, or is that going to be difficult?
I think it is going to be a challenge, but at the same time, if we look at our kind of top performers, they have managed to kind of keep somewhat below our target. So it's definitely not an easy target, but I think it is doable.
In uncertain times and recessions, people tend to be reluctant to even consider changing jobs. It certainly seems to be the case now. Money seems to be secondary. Our clients looking at other ways to attract people. Well, I think they are, and I think they always have been, to be honest. I mean, having a good employer proposition is really important, and obviously that's made up of lots more than just the pay packet.
Yeah, absolutely. I think over the past 18 months, individuals have really kind of had time to think about what they want, who they want to work for, and what they want from their employer. So I think it's probably more important than ever.
Yeah. And last question as it stands is around B Corps. Actually, you mentioned ESG. How important do you see agencies becoming B Corp certified? Have you any information on how this has helped with business growth? I don't think there's enough of them that have been around long enough to know the impact it's had on growth. But Francesca, I think that's something that we could certainly look to maybe focus on in another survey, actually doing a bit of a deep dive on those that are certified as B Corp. Certainly a number of my clients, not that many, but a few have now become B Corps, and others are looking to convert. I imagine that's the same amongst your client base as well, Francesca.
Yeah, and it was actually a question that we asked in terms of our online survey, you know, what proportion of the agency had considered that or were thinking of considering it. And I think it was kind of more than 50% were going to kind of consider whether it would be worthwhile for them.
And that's quite a big percentage, isn't it?
Yeah.
I mean, it's not an unonerous process that you have to go through to be certified as B Corp, but I suppose the more that do it, the more we'll need to do it, because it'll become the norm to be B Corp certified rather than not. Okay, and last question as it now stands is, have you seen any softening of the freelance market in response to IR35?
I think it's difficult to give a response on that across the board. I think definitely some, but I think it depends on what kind of talent pool those freelancers are within.
Yeah, it's difficult, isn't it? Because of course it kicked in for different size agencies at different times. So I think we're yet to feel the full effect of that, but certainly quite a lot of clients are taking a sort of a zero risk approach to this, and are just saying to people that actually we're not willing to risk HMRC coming and clawing all over our numbers and asking for extra tax. So actually you're just going to have to go on the payroll, and actually that will be interesting for our survey, won't it, Francesca, if that happens?
Yeah, interesting to see what that does to the employee cost ratio, and then also the spend on freelancers. I think there's going to be maybe the reduction that we saw this year will actually continue.
Right, we'll do this one last question, coming in thick and fast. With PR being the least affected in terms of revenue, in part due to the retainer model, do you have an initial view for 2021 in this space? I don't know how much we drilled down sector by sector in the survey that we did, Francesca.
No, to be fair, we didn't. We looked at that as a kind of total population rather than by discipline, so I don't have any kind of more data for that specifically.
I mean, my sense would be is that it will have been similarly resilient during 2021. It tends to be one of the more resilient sectors when there are crises, if you look back across the history of our surveys. So my sense is that will be similar situation for 2021 as well. Okay. Right, well, thank you very much, Francesca, and thank you everybody for asking questions as well. Meant that you're all paying attention and you're all still there, which is good to know. I mean, I think really I hope everyone's feeling quite positive about what they've just heard. I mean, given the challenges over the last 18 months and the effect that it's had on revenues and fee income, I think we can safely conclude that the marcoms industry has sort of done itself proud, really, and on the whole has minimised quite a lot of the potential negative impact that could have been had on margins through their quick decisions, their restructuring and their refocusing. And I've no doubt that quite a lot of those decisions that have been made, some of which potentially were decisions that should have been made earlier, and what happened with the pandemic just sort of spurred agencies on to make some of those difficult decisions. Hopefully they will stand agencies in good stead for future performance, and certainly by the looks of it, with a quite punchy forecasts in growth and income for 2022, and even punchier margin predictions. I mean, if average profit margins across the whole industry end up being 15.2, then I think 2022 will be an extremely good year. Francesca also took us through some of the key value drivers that impact agencies, and of course one of those was ESG. And awareness of ESG has grown significantly in the last year, really sort of driven by the power of the consumer in today's market and a united demand from employees, clients and customers and investors to be transparent about the true cost of business. And events such as the pandemic and a rise in natural disasters attributed to climate change have only highlighted the issue further. And the turbulent time over the last 18 months has certainly given agencies some time to reflect on their ESG values. And as you know, we had the question earlier, quite a few of them are considering moving over to B Corp status. So that brings me on to part 2 of the afternoon, our insight session, where we're going to be discussing to what extent good ESG practices can help drive growth and profitability and ultimately build shareholder value. There is certainly a growing expectation that companies should be addressing issues such as climate change and diversity and inclusion, and those that don't could face obstacles with consumers, with attracting talent, their supply chain, or seeking credit or investment. Therefore, it stands to reason, really, that whilst good ESG practice is a commitment to do more than just make a profit, it can also be a virtuous circle and help with profitability. Hence, this session is entitled Be Good for Goodness Sake. That's our attempt as accountants to be a bit creative with our titling.